Welcome to the deep dive. Our mission today is, it's pretty simple, really. We're diving deep into the Sandvik Q3 2025 earnings report. This information hit the wire right around 11:30 CEST on October 20th. Now, for anyone watching closely, this quarter presented a real paradox.
It really did. If you just looked at the headlines, you saw Sandvik missing on revenue and missing on the adjusted margin target.
Right.
But then you look at the market reaction, and the shares actually traded higher.
And that's the core question we need to answer for you today. Why did the market reward what looks like a double miss? We're going to have to synthesize the management commentary from the call and look past those initial headlines to get at the true structural drivers.
Exactly. The story here isn't about the missed numbers. It's about really strong underlying execution getting swallowed by some major macro headwinds.
Okay, so let's start with that snapshot. To understand the enthusiasm, you have to look deeper than just the revenue number.
Well, on the surface, the company reported revenue of 29.2 billion Swedish kronor, which, yes, fell short of what analysts were expecting. And the adjusted EBITA margin.
That's earnings before interest, taxes, and amortization.
Right. It came in at a very respectable 19.0%, but it still missed the consensus target of 19.3%.
So if the stock went up, where was the colossal beat? It had to be in a forward-looking indicator.
Orders.
Orders, precisely. Total order intake just smashed expectations, coming in at 30.77 billion kroner. But the truly game-changing figure, the one everyone was watching, was the organic order intake growth.
And what was that?
It registered a massive 16%.
16%.
In this economic environment, that kind of underlying demand signal, it trumps a slight margin miss every single time.
16% organic growth is a huge signal of strength. It meant the company's book-to-bill ratio was approximately 105%.
And for those who aren't familiar, a book-to-bill over 100% just means they're receiving more new orders than they are invoicing for revenue.
So they're building a backlog. And this is now the third consecutive quarter of building that order backlog. It essentially provides this strong, visible cushion for the quarters ahead.
And it's important to note, this wasn't financed by, stretching the balance sheet. Their financial discipline looked exceptional.
Absolutely. Free operating cash flow for the quarter was robust, standing at 5.6 billion kroner. That corresponds to a strong cash conversion ratio of 105%.
So to summarize the snapshot, surging volume demand, a growing backlog, and they're converting sales to cash efficiently.
Those three pillars. That's why the stock reacted positively.
Okay, let's unpack that margin miss then. If the operational execution was so strong, why did the reported 19.0% margin fall short? It couldn't have just been simple inefficiency.
It wasn't. The margin softness was almost entirely attributable to currency translation effects. Foreign exchange, or FX. And this wasn't just a minor drag. It was a gigantic external punch to the P&L.
How big are we talking?
Well, the FX translation resulted in an 8% negative reduction on reported revenue and a 9% reduction on orders.
A 9% hit on orders.
But the number that really matters for the bottom line is the direct hit to the Q3 adjusted EBITA. Currency impact alone wiped out a significant minus 837 million Swedish kronor.
Wait, 837 million kroner? For context, that's almost 1 billion Swedish kroner just gone, purely due to currency swings. What did that do to the margin?
That single currency headwind diluted the reported margin by 130 basis points.
130. So if you just strip that out, they would have easily beaten the consensus.
Easily. And management was clear. This impact was actually slightly worse than what they had guided for previously.
Yet, despite absorbing a financial punch of that magnitude, the group margin only came in 30 basis points shy of expectations. That tells me the underlying business must be incredibly efficient.
It is. They leveraged their existing volume strength. We saw strong organic operational leverage at the group level of 34%, which added about 0.7 percentage points back to the margin.
And they kept up with cost control.
They did. Their ongoing restructuring programs delivered another 145 million kronor in cost savings this quarter. It's the definition of a resilient business model, absorbing a massive macro hit with underlying structural strength.
And we should also note the tariff issue that everyone was watching earlier this year.
Right, the trade concerns.
Management confirmed that all tariffs and associated costs were fully offset by imposing surcharges on their customers in Q3. That's just superb risk mitigation.
And structurally, the balance sheet is fine. They have net debt of 41 billion kronor, but that is easily managed. The net debt to EBITDA ratio is a very comfortable 1.2 times. They have plenty of flexibility to ride out these currency cycles.
Okay, so we've established the financials were resilient due to exceptional execution. But where did that crucial 16% organic order momentum come from? Let's transition into the operational side, and specifically to Sandvik Mining and Rock Solutions, or SMT.
SMT is absolutely dominating the story. Sandvik's mining business continues to show phenomenal strength, and it's driving that group-wide order growth.
What was the number for SMT?
Organic order intake for SMT grew a stunning 24% in the quarter.
24% is phenomenal. Was it driven by a few massive contracts, or was it more broad-based demand?
It was a bit of both, but the underlying demand is very healthy. They did book approximately 1.6 billion kronor in what they call major lumpy orders. But even when you strip those out, the organic intake was still a very healthy 16%.
So identical to the group average.
Exactly. The momentum is broad-based across all product categories. We saw double-digit growth in both the service business and in digital mining solutions.
And that's important because those are the high-margin, sticky, recurring revenues, right?
That's it. They're tied to their existing installed base. Equipment growth itself was also up a massive 75% year over year.
Wow.
Though, to be fair, management rightly cautioned that this number benefited from a very weak, comparable quarter-a-week Q3 in the prior year.
Let's talk about the metals driving this. Is it just a gold rush?
Gold is certainly strong. It's about 35% of their mining business. But copper is equally important, making up 25%. High prices for both mean miners are willing to invest heavily. Bulk commodities like iron ore showed stable replacement demand, but coal investments are definitively down.
And here's where it gets interesting, the mix of projects. Management highlighted that brownfield projects, expansions at existing running mines, were particularly strong.
They were. They represented 70% of the order intake. Usually that figure is closer to 50%.
What's the significance of that brownfield surge?
It's excellent news for the quality of the backlog. Brownfield projects are inherently less risky than greenfield projects, digging a brand new mine from scratch. They require faster equipment deployment and generate quicker aftermarket revenue.
And greenfield was lower.
Yeah, lower at 5%, which management suggests is just the natural lumpiness of that category. That 70% brownfield mix gives them high quality, high certainty revenue.
We also need to touch on the internal hiccup they noted in SMT. They mentioned a residual hit from their Q2 ERP system go live.
Yes, they quantified this. The new enterprise resource planning system required extensive internal adjustments, and that led to about 30 basis points of negative EBITA impact.
What was that from?
Extra costs, like having to expedite shipping, literally flying heavy machinery parts instead of sending them via cheaper, slower ocean freight.
Wait, flying goods instead of shipping them? That shows how desperate they were to meet that massive backlog and avoid upsetting their customers. It really underscores the pressure on execution.
It certainly does, and they expect a tiny bit of this residual impact to linger into Q4. Crucially, they also noted the stickiness factor is growing. Aftermarket penetration of their own installed base is now pushing towards 60%.
Up from about 50% 5 years ago.
Right. That growing share of services is crucial for their structural margin health.
Let's pivot now to the second major segment, machining and intelligent manufacturing, or MEM. If SMT was phenomenal, how did MEM perform?
The picture here was definitely more mixed, as we expected. They saw strong double-digit growth in key high-growth areas like aerospace, defense, and medical. Underlying demand in general engineering also remained stable.
But the weakness was clearly visible in automotive.
Correct. Automotive demand was down in the low single digits. But the innovation pipeline looked strong. They highlighted the launch of the Mastercam Copilot, which is an AI-based solution. And their software and intelligent manufacturing technologies continue to grow at a low double-digit clip.
We mentioned the group-level FX drag earlier, but MIME had its own very strange margin anomaly, an additional organic drag of about 100 basis points. This is highly technical, so let's try to simplify this for the listener. What exactly caused that hit?
This was a genuine one-off anomaly. It stemmed from a non-hedged internal currency flow. Just think of money moving between Sandvik's different regional distribution centers.
Okay.
A few months prior to the quarter, the Swedish krona sharply strengthened. Because this internal flow wasn't externally hedged, it effectively created a loss.
So they basically got penalized internally for a failure in their hedging process, and they called it an organic drag.
Exactly. And this is key. Management chose to treat that failure as an organic operational cost within the MIM division, not just a macro FX hit. It sends a clear signal about operational discipline.
So it's a one-off.
It's an anomaly that is unlikely to be repeated. They're already improving processes to hedge these flows moving forward.
That context is vital. Okay, finally, let's touch upon the third segment, rock processing.
Order intake here was flat on a reported basis, but if you look underneath, it organically grew a solid 9%. The key highlight was the positive acceleration of dealer activity in the U.S., particularly driven by demolition and recycling.
And strategically, what was their key move there this quarter?
It was proactive margin defense. They launched a new specialized jaw plate range. This is designed specifically to sustain margins in the wear parts aftermarket. Wear parts can become highly commoditized, so this is about protecting their future profitability in a vital recurring segment.
So we have exceptional order momentum led by mining, resilient margins despite massive FX pressure, and management flexing operational muscle. What does this mean for the road ahead? Let's connect this to the forward guidance.
Well, the first major question from analysts was capacity. Could they possibly execute on that 16% organic growth? Management confirmed a successful ramp-up. They can be flexible because about 70% of their cost of goods are purchased components and about 50% of assembly is outsourced.
So they can bring new lines online quickly.
Right, like the new facilities in Finland, Malaysia, and India without committing to heavy, fixed, long-term capital expenditure.
That flexibility is a huge advantage. You also pointed out a fascinating dynamic in the cutting tools market in China.
Yes, this is a potential game changer for long-term pricing. High tungsten prices have been persistent. This has forced local Chinese cutting tool competitors, who historically operate on razor-thin, near-zero margins, to raise their prices significantly for the first time in memory.
That is massive, because Sandvik competes directly with these low-cost players. If the price floor rises for everyone, Sandvik's premium offering suddenly looks much more competitive.
Precisely. It creates a much more favorable pricing dynamic for them in the world's largest manufacturing market.
Let's look ahead to Q4. We saw the Q3 FX hit was 837 million kronor. What is management signaling for Q4?
The big headwind is getting even bigger. Management is expecting a continued negative currency impact on operating profit in Q4 of approximately minus 1.0 billion Swedish kroner.
A billion kroner.
1 billion. And this is based on currency rates as of the end of September. That is a substantial hit that investors have to fully factor in.
That means we are going to see ugly headline margins, regardless of how well they execute. Otherwise, the rest of the guidance is stable.
Yes, stable. CapEx still guided around 4.5 billion, interest net around minus 0.8 billion, and the normalized tax rate remains between 23 and 25%.
So the key catalyst to watch between now and January is really twofold then.
Right. First, how well management executes on pricing and mix to absorb that 1 billion kroner currency hit. And second, whether the high prices for gold and copper can sustain this incredibly strong mining order run.
Okay, now let's pivot into our segment. This is not financial advice. We've established the paradox, incredible underlying execution, but a looming severe financial headwind. Let's imagine we are pitching a high-conviction, slightly outrageous but plausible trade idea to an investment committee.
The core insight here is that the market loves the structural demand. That Q3 105% book-to-bill ratio is a clear signal. However, that SEK 1.0 billion negative FX impact guided for Q4 is so large, it's almost guaranteed to generate extremely ugly margin-compressing headlines when the results drop on January 27.
That sets the volatility window perfectly. So my pitch would be go long Sandvik immediately after the Q4 earnings report on January 27th.
So you're betting on a knee-jerk temporary panic sell-off driven purely by the accounting noise. The thesis is that short-term investors, the ones focused solely on the margin headline, will dump the stock when they see that massive currency hit realized in the P&L.
Precisely. We ride the panic down knowing it's just temporary noise because the market will immediately pivot back to the underlying structural growth story.
Right. The 105% book-to-bill and the ramped-up capacity mean that 2026 is poised for a clean, unencumbered, high-growth period once this severe FX drag is fully lapped.
So the stock recovers and rallies quickly as attention shifts back to the operational strengths, not the temporary accounting narrative. It's a classic volatility play.
A classic case of operational strength hiding behind financial headwinds that you can leverage.
Absolutely. So to wrap up this deep dive, Sandvik's Q3 was defined by exceptional execution on orders and cash flow, which successfully absorbed a temporary, albeit massive, currency blow.
That's the key takeaway for you. Focus on the 16% organic order growth and the cash conversion, not the headlines about the margins.
And here's the question for you to consider as you continue your own research. Given the continued positive momentum in rotary drill rigs and Sandvik's ambition to become the clear #2 player in large surface drilling, How quickly will their recent rotary wins, which are heavy, expensive equipment, convert into a material revenue contribution in the next 2 to 3 years, fundamentally shifting their market position? Something to chew on.